Have you ever wondered why so many people pay thousands of dollars in financial advisor fees, only to end up with lower returns than the overall market? What if I told you there's a simple investing strategy, used by everyday investors and millionaires alike, that has outperformed most financial advisors for decades? It's called the three-fund portfolio. And today I'll show you exactly what it is, how it works, and why it could help you retire wealthier without complicated charts, constant market timing, or high management fees. So if you've ever felt overwhelmed by investing, this is the video you've been waiting for. The truth is, most people make investing harder than it needs to be. They chase hot stocks, listen to random YouTubers or gurus, and jump from one mutual fund to another, hoping to strike gold. But according to data from Morningstar and Vanguard, the average active investor underperforms the market by around 2 to 3% per year after fees. That might not sound like much, but over 30 years, it can mean hundreds of thousands of dollars lost. That's why the three-fund portfolio has become such a powerful movement. It's simple, diversified, low cost, and backed by decades of data. And here's the best part: anyone can build it. Whether you're in the US, Canada, or the UK, you can apply the same principles to build long-term wealth safely and efficiently. What is the three-fund portfolio? The three-fund portfolio is exactly what it sounds like: just 3 index funds. These funds represent the entire global economy, giving you diversification across thousands of companies, industries, and regions. The classic version looks like this. U.S. Total Stock Market Index Fund covers companies like Apple, Microsoft, and Tesla. International Stock Market Index Fund gives you exposure to companies in Europe, Asia, and emerging markets. U.S. Total Bond Market Index Fund adds stability and income to balance the risk. By combining these three, you get exposure to tens of thousands of companies worldwide. With just 3 funds, that means you don't have to guess which stock will win next. You already own a piece of everything. Why it beats most financial advisors. Now, here's where it gets interesting. According to research by Spiva, S&P Indices versus Active, over 85% of actively managed mutual funds underperform their benchmarks over a 10-year period. That means if your financial advisor is picking mutual funds or actively trading for you, the odds are heavily against them beating a simple 3-fund portfolio. Why? Because of fees, taxes, and human behavior. Advisors often charge 1% in management fees. Many mutual funds charge another 1% in expense ratios. Combine that with emotional trading and market timing mistakes, and the result is lower returns. In contrast, index funds like the ones used in the 3-fund portfolio often have expense ratios as low as 0.03%. That's like paying $3 per year for every $10,000 invested. So instead of losing 1 to 2% every year to fees, your money compounds faster. And over decades, that difference becomes massive. For example, $10,000 growing at 7% annually becomes around $76,000 after 30 years. But if you lose just 1.5% to fees and only earn 5.5%, you end up with $48,000. That's a $28,000 difference. Gone, just because of unnecessary costs. How to build your own 3-fund portfolio. Let's break it down step by step. Step 1. Pick your brokerage. You can use Vanguard, Fidelity, Charles Schwab, or Wealthsimple for Canada, or AJ Bell for the UK. These platforms offer low-cost index funds and ETFs. Step 2. Choose your 3 funds for the US. Vanguard Total Stock Market Index, VTI, Vanguard Total International Stock, VXUS, Vanguard Total Bond Market, BND, for Canada. Vanguard All Equity ETF Portfolio, VQT, or Combine. VUN plus, VIU plus, VAB for the UK. Vanguard FTSE Global All Cap Index Fund, Vanguard Global Bond Index. Fund Step 3. Pick your allocation. This depends on your risk tolerance and time horizon. Example: allocations. Aggressive, long-term growth. 80% stocks, 20%. Bonds moderate, 60% stocks, 40%. Bonds conservative, 40% stocks, 60% bonds. The key is, the younger you are, the more stocks you can hold. As you approach retirement, shift more into bonds for safety. Step 4. Automate your investments. Set up automatic monthly contributions. That way, you're consistently investing, regardless of whether the market is up or down. This is called dollar cost averaging, and it helps reduce the emotional roller coaster of investing. The psychology behind why it works. The 3-fund portfolio doesn't just work because it's simple. It works because it keeps you disciplined. Most investors fail not because they choose the wrong stocks, but because they react emotionally, selling during downturns and buying at the top. With a 3-fund portfolio, you're diversified globally. You're not chasing returns, and most importantly, you're staying invested. Legendary investor Jack Bogle, the founder of Vanguard, said it best: "Don't look for the needle in the haystack. Just buy the haystack." Real-life example. Let's take a real example. If you invested $500 per month into a 3-fund, portfolio earning 7% per year for 30 years, you'd end up with around $610,000. Now imagine you paid an advisor 1% in fees. You'd have roughly $520,000, nearly $90,000 less. That's the power of doing it yourself, simply and consistently. The beauty of the 3-fund portfolio is its simplicity and proven results. You don't need to check charts every day or guess where the market is going. You just invest, stay consistent, and let compound growth do the heavy lifting. So if you're serious about building long-term wealth, start simple. Start smart. And remember, you don't need a financial advisor to get rich. You just need a plan that works. If you found this helpful, hit like, subscribe, and turn on the bell icon for more wealth-building strategies every week, only on Asset Bloom.